Okay, good day everyone. So today I'll be doing an explanation on how to spot the breaker block, the breaker structure, the market structure shift, and the order block, and also how you can use that to take your entry. So for those asking me on Instagram how to use the breaker block, and also those that say they don't understand how to use spot the breaker structure on the chart, make sure you watch this video to the end and don't skip any part so you won't miss the explanation. So from last week, remember I said if you see price moving in this direction for an uptrend, or you see price moving to the downside for a downtrend, so remember this is the previous high for an uptrend, and this is the previous low for a downtrend. And remember, the breaker structure, for the breaker structure to be valid, price has to break above the previous high with a full body candlestick, or break below the previous low with a full body candlestick. So that will make the breaker structure to be valid. If price break below the previous high, or you see price break below the previous low with a weak candle, that's an invalid breaker structure, and you might as well see a reversal after those kind of movements from price. So be sure about the setup. Always wait, be patient for price to break above the previous high or the previous low with a full body candlestick. It must not break above or below with a weak candlestick. So now there are key things you should always watch out for each time price creates a break of structure, or you see price creates a market structure shift. There are key things you should always look out for each time you are looking for a setup on the chart. Anytime you open the chart, are key things you should always look out for. So the first thing you should always look out for each time you open the chart, so first thing you should always look out for: number one, check if price is moving in a particular trend. Let's say check price, or let's say check the trend of the check market trend. First thing, you check the market trend. Check if price is moving in an uptrend or a downtrend. After that, check if price so sorry so check if price has created a market structure shift. So after you check for the trend, next thing, check if price has created a market structure shift to tell you if the trend is still valid or the trend is invalid. So once you say a market structure shift, that will tell you the trend is that particular trend that price was moving before. That trend is not valid, and you expect to see a reversal to the opposite direction. So after that, third thing, we make the text very bold. So if price is still creating multiple breakout structure, once you check the charts and you check the market trend and you see if price is still creating multiple breakout structure in one direction, either uptrend or downtrend, and let's say there's no market structure shift yet, you check for breakout structure, check for the order block, the breaker block, or fair value gap. So that's order block, breaker block, and fair value gap will let you know that price is still going to continue on that particular direction. And for an uptrend, you can see the breaker block at this point. For an uptrend, you can see the breaker block at this point. For an uptrend, for a for an uptrend, you can see the order block at the bottom. This is for a breakout structure, so see the order block at the bottom. You can also see a fair value gap sometimes here. You can see a fair value gap here at times. You can see a fair value gap here at times. You can also see a fair value gap protecting the breaker block. You can also see a fair value gap here at times. Protecting the breaker block. So in cases where you just see only the breaker block for an uptrend, in cases where you just see just the breaker block, price will just retest on the breaker block. Price will just retest on the breaker block, then push on the upside again to take out buy side liquidity. Then in cases where there's also an order block, so in cases where there's also an order block, you see price first come for the breaker. Sorry. You see price first come for the breaker block. First on the breaker block, take out buy side liquidity, and you see price come back for the order block again before final distribution to the upside. So remember the first one, if there's no order block, price will use just the breaker. While if there's an order block and there's a breaker block, price will use the breaker block first, then come back for the order block. So in cases where there's no order block or there's no breaker block, but there's a fair value gap here, let's say there's a fair value gap there, price will use just that fair value gap. Price will use just that fair value gap in order for you to continue on that particular trend. So you should always spot out for these three things when price is creating a breakout structure. Same thing implies for a downtrend. If you see price creating a downtrend, same thing applies for that too. So for a downtrend, breaker block is always at this point. Breaker block is always at that point. So since it's just a breaker, since there's no order block, there's no fair value gap, it's just the breaker block. You see price now use the breaker block, just the breaker block, then distributes to the downside in order for it to continue on that particular trend. Then in cases where there's an order block at this point for a downtrend, after price use the breaker block, it will come back again for the order block before distributing again to the downside. In some cases where there's no breaker block, and there's no other block, but there's a fair value gap here. Price will just come for the fair value gap. Then distribute to the downside just for it to continue that particular trend. So this is how you can always get a setup when you open the chart and you see price is creating break of structures. You can always use this pattern to always get your entries. And also I'll be talking about inducement. So for those asking me what's an inducement, so an inducement is the first pullback price creates after a break of structure or a market structure shift, and the inducement is not meant to mitigate or tap into the breaker block, the order block, or let's say the point of interest. So let me quickly type that on the screen. So an inducement is the first pullback price creates after a break of structure or a market structure shift, and the inducement is not meant. So let me make a quick correction here. Okay, so the inducement is not meant to mitigate or tap into the order block or breaker block after the break of structure or market structure shift. It acts as a sorry, it's supposed to be a full stop here. Okay, it acts as a liquidity guiding either the breaker block or the order block. So this is what an inducement mean if you follow the definition there. So once you see price creating break of structures, you see price creating break of structure in this direction, and let's say for example there's a breaker block here. After the break of structure, there's a breaker block there. Remember, inducement is the first pullback price creates after a break of structure or a market structure shift, and the inducement is not meant to mitigate or tap the order block or breaker block after the market structure shift or the break of structure. and it acts as a liquidity guiding either the breaker block or the other block. So now from here, after the breaker structure, since this is the first pullback is not meant to mitigate or tap into the breaker block. For an inducement, you will see the first pullback just move in this direction, just a few pips from tapping into the breaker block. Then you see a reversal to the upside. So automatically, this is the inducement, which is the first pullback after the breaker structure. Is the first pullback after the breaker structure here. So this is the inducement. IDM, that's the inducement, and it acts as a liquidity guiding the breaker block. So now when price come for that liquidity, price always aim for liquidity. So now when price come for the liquidity, it will now sweep out this inducement, which is the liquidity, sweep out the inducement, then tap into the breaker block before distribution to the upside. And another case also, you can see price now, let's say price moving in this form, it creates a breaker structure, and let's say there's an order block here, and there's also a breaker block somewhere here. You see price now come for the breaker block first. Take out liquidity, come back again. In most cases, you can see something like this, like price will nearly tap into the OB, and you see something like this. You see pullback, then you see price come back again, tapping into the OB, then creating a market structure shift at this point. See price retest again. After the market structure shift, then distributes to the opposite direction. So most people will mark this as the inducement, which is the first pullback. Most people will also mark this as the inducement. So me, I prefer marking this second one as my inducement, since there's a valid breaker block. So I will mark this second pullback as my inducement. So this just everything about inducement: the first pullback after a breaker structure or a market structure shift. And for the market structure shift, since there's a price creating multiple highs, breaker structure, then suddenly you see the market structure shift to the downside. Price creates a market structure shift here. The MMS. So after the market structure shift, there will be a breaker block here. Let's say there's a valid breaker block here. And there's also a valid order block here. So now we expect price now to use the breaker block first. Then distribute to the downside, coming back again. Then you see something like this. Before price tap into the order block, you see something like this. You see rejection. Then you see price now reverse back, mitigating the order block, creating another market structure shift at this point, retesting before final distribution. So most people now, they will also mark this as the inducement, but I don't use that as my inducement. I use this second pullback here as my inducement. So I use that second pullback as my inducement here. So that's how you can always use this for your strategy. So this is how you can mark your inducement. So that's pullback there is the inducement. Second pullback is the inducement. Second pullback is the inducement. So on the charts now, for those asking me if how can you be able to look for a trade once you open the chart. So what I do basically most times, I don't do back testing all the time. I don't do back testing from months back or weeks back. I just follow the trend of the market. Like I can just open the market, see prices moving in a downtrend. Depends on the time frame, but I don't like using 5 minute time frame to do my analysis. I like using within the 1 hour time frame. From the 1 hour time frame, from 15 minutes to 1 hour time frame. That's what I like using for my analysis. So I can just decide to go to the 1 hour time frame. So for that week, if I can see the price is moving in one direction or price is moving in an uptrend for the 1 hour time frame, then I'll move down to 30 minute time frame, 15 minute time frame, just to look for a setup in that direction. But most times I can just use, let me say I want to just take a quick trade as a day trade. I want to take a quick, because if you decide to use those 4 hour time frame for your setups, you have to wait every 4 hours for a new candlestick to form, and that will take a very take a long period for new candlesticks to form on the 4 hour time frame. You have to wait for every 4 hour for a new candlestick to form, and we have just 24 hours in a day. So imagine the kind of time you have to wait for new candlesticks to form. So it's much better to just identify the trend on those time frame. Identify the trend on those time frame, then move down to lower time frame to take those entries, either on the 1 hour time frame, the 30 minute time frame, or the 15 minute time frame. So before that, I already got my buyers on gold. I know gold is moving on an uptrend or is in a bullish direction. We all know gold is in a bullish direction, and from this point here, this region here, we have on the 1 hour time frame. If you go to the 1 hour time frame, we have a breaker block there that is not mitigated. So on my previous videos, I already talked about this point here. So we all know that point is not mitigated, or price hasn't tapped on that point yet. So it's still valid, and price has been moving just like that. So we see price is still moving in a bullish direction. So now what I'll be looking for setups towards this direction. I'm looking for market structure shift setups towards this direction, or break of structures towards that direction. So I'll just follow the trend until price tap into that point. So now I'm just following the trend on lower time frame. After I spot the trend on the 1 hour time frame, spot the uptrend on the 1 hour time frame, then I move down to lower time frame. I'm using the 15 minute and 30 minute time frame, but including 5 minutes for my setups. So I move down to a lower time frame to spot those entries. So from here, we all know from 2 weeks or I think 3 weeks back, price has been creating breakout structures to the downside. Price has been creating multiple breakout structures to the downside, and each time price break below, sorry, let me mark that again. So, and each time price break below, it always break below with a full body candle for the breakout structure to be valid. So see, kept moving to the downside. See multiple breakout structures to the downside, and so you can always mark this breakout structure. When you mark the first breakout structure, For example, when you mark your first break of structure here, if you say your first break of structure is from this point, your next pullback should price must retest on a breaker block or an order block for your next pullback before the distribution again to the downside for the next break of structure to be valid. If you see price creates a pullback to this direction, and you see this pullback didn't retest on any breaker block or any other block, just know that pullback price might eventually come for it as a liquidity, or if there's an order block within that region, price will eventually come for it as a liquidity to mitigate that order block or breaker block before distributing to the direction of the trend. So now it has been creating multiple breaker structures down up to this point here. So created breaker structures here down to this point. Then you see this movement up created a market structure shift at this point, meaning price broke above this previous high. This is a recent high. This is a last high the market created on the last break of structure. That's the last high. So price now broke above that high. It has automatically turned into a market structure shift. So the next thing you should look for is for you to find a breaker block or for you to find an order block. So on this particular trade, I spotted that on the 30-minute time frame. So you have to use multiple time frames. So on this time frame now, you can clearly see the breaker block here. You can clearly see that breaker block here. So I'm using the body of the middle candle. I don't use the wick of the middle candle. I always use the body of the candle at the middle of the breaker block or at the middle of the order block. So I'm using the body of the candle. And remember what I said, after a market structure shift, the first pullback, if price didn't mitigate the order block or price didn't mitigate the breaker block, the first pullback after the market structure shift, that's your inducement. So now this is the first pullback. Now after the market structure shift, you saw this pullback didn't tap into the body of the candle of this breaker block. It just did just move a few pips down, then reject to the upside. So it did a few pips down, reject to the upside. So now this region has automatically turned into your inducement. So that's why I put the IDM there as the inducement. Then I mark the breaker block, which is unmitigated. I mark it out at that point. So now price created the first breaker structure. Now see price has changed from this downtrend to an uptrend. So now if on the first week now we are on a downtrend for this first week, then on the next week you saw a market structure shift. So once you just open the chart, no need for you to go back and do multiple back tests on previous trades, checking higher time frame and all the stuff like that. You just have to just follow the trend. So now you follow the trend for the day. Trend of the day has turned into bullish because of the market structure shift. So now you just follow that trend for the day, and you can get the least two setups, or if you decide to take just one setup from that trade, depending on the time frame you are trading on. So now this is the first break of structure. After the break of structure, what you should look for next is for you to look for a breaker block or order block that price will probably retest on. So if you go down to lower time frame, you can clearly see there's an OB here. But price didn't tap on it very well. You can see the little pips there for price to just mitigate. Then you see price push to the upside again after the break of structure here. After this break of structure now, what you should look for next is for another order block. So this is the next order block at that point then. And you see price now mitigate into the order block, distributed to the upside, creating another break of structure here. So after the break of structure, what you should spot for next, say I took the trade from this region here, then I aim for the inducement. There's an inducement at this point here. It's an inducement at this point here. So the reason why I marked that inducement was because on this 15-minute time frame, I took a trade on this point, I think last 2 weeks, on this point using this breaker block. So I use the breaker block, and if you should follow this pattern I drew here, remember, once there's an order block and there's a breaker block, price will first of all use the breaker block before coming back to use the order block. So at this point, there's a breaker block at that area. Then you drop down again to 5-minute time frame. You will see there's an order block. After this breaker block, you can see this order block here. The price will probably retest on. So I quickly drew that out as my OB. That's this line. I drew that out as my OB. So you can see the liquidity here protecting this order block. Liquidity is protecting the order block. So that's why I put my first take profits coming. So that's why I put this take profits at the tip of the inducement, because I'm expecting price to take out that liquidity before tapping into the order block. We see price just use a weak candlestick at that point. It used a weak candlestick at that point, so it hasn't taken out the inducement finally. And you can also call this your inducement also. You can also call this your inducement too, but most times price can decide to use 2 inducements. Also call that your inducement also. So you can see after the okay, let me go back again to 15-minute time frame. So after this retest on this OB at that point, it's created a break of structure here again. After the break of structure, you should look for an order block or a breaker block. So on my previous video, if you watch my previous video, you will come across some videos where I talk about how to know if a breaker block or an order block is valid. So for you to be able to know if a breaker block and an order block is valid, you have to watch those videos so you can be able to understand. So this is the breaker at that point. So if you should trace it back, see price retested on it, then came for this liquidity here. It came for that liquidity here, but price didn't break above there with a full body candlestick. So that's to tell you the break of structure there is not valid yet. So I'm expecting price now to push to the downside from here. Expecting price to push to the downside from here to retest on this breaker block before distributing to the upside, coming for this other block. Then final distribution again to the downside again, then using that breaker block down for distributing to the upside. So this is what I'm expecting price to do on gold. So my main aim right now is to just focus on the trend. I'm just following the trend. So you can decide to enter the setups aggressively. Multi-price just tap, just enter. You can decide to enter the setups aggressively, and you can also decide to wait for confirmation. When I mean confirmation is that if price to come back for this breaker block here, you will see a movement like this, something like a market structure shift. Okay, coming. So you see something like this on the lower time frame, not on this 15-minute time frame. You see that on the 5-minute time frame. So you see something like this when price will tap in. Then you see a market structure shift, very little, very tiny. Then you see a pullback again, returns on another block. You see price go for this point, this OB. Then you see same thing again at this point. After tapping in, you see another market structure shift again. Then you see price come for this breaker at the bottom. You see same thing again. After tapping in, you see another market structure shift again, reaches on breaker or another block, then going back to the previous high. So you can always use this as your confirmation. You can always enter the trade aggressively. So there are two things. These are the two ways you can take the trades. And one thing you should always know when taking trades like this, when using this strategy like this, is to always understand your risk management, because all strategy works. It's just how you use it and how you manage your risks that really matters, because most times you see some traders will be like, some newbies rather, be like, I'm using this strategy with this same trader or this big trader. It works for him, but it doesn't work for me. He uses the strategy to get big profits. Why, if I use this strategy, I always end up with loss most times. It's because of the way you manage your risks and the way you trade, and also your psychology level too, because all strategy works. All strategy works, just how you use it, how you manage your risks. Each strategy acts as a risk management, and also how you can manage those risks and how you can handle your psychology level really matters a lot. So if you look all my trades now on all, including Euro USD, GBP USD, and gold, both BTC USD, if you look at my stop loss, they are always the same. I use the same pips for all my stop loss. This is why I use that, is that, okay, I will explain it. So this is why I use same pips for all my stop loss, is that, for example, let's say I place a rule. For example, I'm taking 3 trades in a day, and for those 3 trades I'm using 1:3 for those 3 trades. Let's see, I'm using 1:3 for those 3 trades now. So let's say these are the 3 trades. I'm using 1:3 for those 3 trades, and what I normally do is that for these 3 trades, if I'm taking 3 trades in a day, or I'm taking 2 trades in a day, I always use the same stop loss for each trade, and I also use the same lot size for each trade. I don't increase my lot if I win the first trade, or I lose the second trade, or I lose the second trade and I want to take the next trade. I don't increase my lot size more than the first lot size I use. I can only decide to decrease the lot size, but I don't increase it. So I will explain that also. So now I'm taking 3 trades now. The first trade, let's say this first trade now. You also know for that, you also know most people will be like, risk 1% of your account. If you are using a $10 account, you risk $1 per trade. So that's what most people normally say, but that can only help you depending on the kind of strategy you use. For this kind of strategy I'm using now, I can decide to use risk that $1. Some people like risk $1 to gain $3. That's 1:3. But me, I don't usually follow risk to reward ratio. I normally aim for liquidity, or the minimum risk to reward I can use is 1:7. I can risk $1 to gain $7, or $1 to gain $5. That is the minimum I can go. That is for someone risking in $1 per trade. So some people like risk $1 per trade. So that can only work for you if you are a beginner trying to grow your account. Yeah, you are using a $10 here, but you can't expect me to be using a $1,000 account, and you expect me to risk $1 for each trade on a $1,000 account. Imagine how long it will take you for you to be able. Imagine, okay, in a month, and for that 30 days in a month, you can't always get a win every day. You can't get a win every day in a month. So imagine there are 30 days in a month, you are risking $1 per trade, and in a month you gain, just out of that 30 days, meaning you have 30%. Out of that 30%, you gain just, let's say, 17%. So you are just 70% up for that month. And if you're the kind of person that you normally use a 0.01 lot size, for example, for you're using a 0.01 lot size for a $10 account, risking 1%. Imagine using a $10 account risking 1%, and you're using a risk reward ratio of 1:3, as you are gaining $3 for each trade, and you gain just 17 trade for that month. You gain just 17 trade. That's if you trade every day. Or let's exclude weekend, for example. If you exclude weekend now, let's say it will be like 27 days. Let's say out of that 27 days, now you gained 13 trades, or you gain 12 trades for that um 12 trades for that month now, and you are gaining $3 for each trade. If you multiply 3 times 12 and look at the dollar you'll be making in a month for that account. Now imagine if you are trading a $1,000 account now, and you're risking $1 per trade for that stuff. It won't be worth it. So all that depends on the kind of strategy you are using. If you are the kind of person that are using big stop loss, yeah, that's for you. If you're the kind of person that are using tight stop loss, but your risk to reward is very big, yeah, that will be on your favor. But if you're the kind of person using a smaller risk to reward, like 1:3, it will be on a big disadvantage for you. So that can only help those using a large risk to reward ratio. That 1% risk per trade can work for those using a large risk to reward ratio. So now, for this first trade, for example, now I'm risking 10% for this trade. Let's say my account is $100, so I'm risking 10% for this trade. But let's say, okay, my account is $10 now for this trade. My account is $10 now for this trade. I'm just giving an example on the way my risk management work. So for that first trade, now I'm risking 1% of my $10, which is $1. Risking 1% of my $10, which is $1. It's a stop loss. Stop loss is $1 for the first trade. Then for the second trade, same thing. Since I use same lot size and same pips for my stop loss. For the third trade, same thing also. So now, yeah, I'll be aiming for $3 since it's a 1:3 risk reward ratio. I will be aiming for my TP. I will be aiming for $3 for this first trade. And I'll be aiming for $3 for this second trade. I'll be aiming for $3 for this third trade. And let's say for this first trade now, I use a 0.01 lot size for this first trade. 0.01 lot size for this first trade. Second trade, I use 0.01 lot size. And the third trade, I use same 0.01 lot size for this third trade. Imagine I win this first trade now. If I win this first trade, if I win this first trade, I'm risking 1% to gain 3%. So if I win this first trade, I'll be up 3% for the day. If I win the first trade, I'll be up 3% for the day. That's I won $3. So if I risk 3% for the next, if I win the next trade, I'm also up 3% for the day. And if I win the third one, I'm also up 3%. So by the time you add up this 3%, it will give you a total of 9%. Give you a total of 9%. for the day, meaning your total profit will be equal to $9. $9 for that trade for that day, since I'm using same lot size, same stop loss, same take profits for the pips for the take profit is the same thing. So I'll be gaining $9 for that day. So let's say, for example, I lost this second trade. I lost this second trade now. I'll be down 3%. If I lost this second trade, I'll be down 3% for the day. So now, if you add up the first trade, if I won the first trade 3%, lost the second one minus 3%, won the third one 3%. So I'll be up 3% for the day. I'll still be up 3% for the day, even though I lost one trade out of the two. I'll still be up 3% for the day. So my profit for that day now, I'll be up 3% for this trade. My profit for that day will be $3, even though I lost one trade out of the three. So my profit for that day will still be $3 for the day. So in cases, for example, let's say I lost all the trades. Say I lost this trade and I also lost this trade too. Now, since I'm risking 1% to gain 3%, if you should add up all the losses now, since I'm risking 1% to gain 3% now, if you should add up all the losses now, you see for this first trade, I'll be down 1%. For this second trade, I'll be down 1%. On this third trade, I'll be down 1%. So if you should add up the 3% now, I'll be down 3% for the day, and my profit now will be minus $3. So I'm risking 3% there, and I lost 3 trades. My profit my total percent for the day will be minus 3%, and my total profit will be minus $3 for that day. So total profit will be minus $3 for that day. So you see how using the same lot size for 3 trades really matter. And one thing you should note is that if you start up your first trade using your normal lot size, let's say your normal lot size you use is 0.01, and you start up your first trade using 0.01, even though you win the trade or you lose the trade, never add more lots to that trade. Never increase your lot size on your next trade. You can only decide to reduce the lot to a lower lot size, but never increase it to a higher lot size just because you want to make more profit. Never increase it to a higher lot size, because if you should increase it to a higher lot size, that if the market should go sideways, it will clear up all the profits you have made for that day, leaving you on the minus side. So always note, never increase your lot size after your first win or your second win. Never increase your lot size. Always use the specific lot size you normally use, or you can decide to decrease the lot size. And one thing you should note is that never add a position, or never add multiple positions to either a winning trade or a losing trade. Never add multiple positions to that trade. So what I mean by that is that, for example, you take a trade from here and your take profit was at this previous low, and let's say price move from this point to tap into your point of interest, and price started moving in your favor. Then price started moving in your favor, and you were following the trend as usual. Now, then from this point on, you decided, okay, price is moving in my favor. Let me just add one more position to this trade so that I can make more profits. Then you came to this point now. You added another position here. Let's say you added another position here. You use the same stop loss for the trade. You added on that position, the same take profit, the same stop loss for the trade. The price kept on moving down and you're on profits. You're on profits. So watch how this kind of situation can trigger your psychology. So now you're on profit, then suddenly price reverse back to the entry. So now you see price reverse back to the entry. So you'll be thinking of two things. Either price will retest back on this point, push down, or move above. That's the two things price can probably do from this point. So now your psychology now will trigger. You'll be like, okay, either let me just increase my stop loss higher. Let me increase my stop loss higher. Or let me remove my stop loss. Whatever want to happen, let it just happen. So that's the two things that will come into your mind. Either to increase your stop loss or to reduce your to remove your stop loss. So now if you should remove your stop loss now, for example, and you're expecting price to reverse back from this point, and let's say price now continue to go higher until it got back to this point again and eventually broke and hit your stop loss. Now you'll be on a bigger loss because first thing, this trade now is already running on a big loss. Then price came and hit your second stop loss, so that you'll be on a bigger loss on the day. So this is why you should never open another position when you are on a winning trade or on a losing trade. If you want to open 5 positions for a trade, or you want to open 10 positions for a trade, open everything at the beginning, not when price has already starts moving to the downside or the upside before you decide to open another position. Open the positions from the beginning of the trade. And also, if you should decide to say, okay, you want to increase your stop loss, for example, now you want to increase your stop loss to this point, you should not price will still go and hit your stop loss and you still be on a bigger loss for the day. So always learn to take your entries either from the very first point, or don't just bother to add more positions. If you open one position from this point, if it's only one position you open from this point, use that position till price hits your take profit. Don't add more positions to it. And if you say you want to open 10 positions, open the 10 positions from that point. Don't say after price has moved a few distance then you open another one, because price might reverse and you'll be on a bigger loss for the day. That's if you are on a winning trade. Then also, if you are on a losing trade, for example, coming, so let's say you take your entry from here now. Let's say you're on a losing trade, for example, price move from this point and it was supposed to start from this area before pushing down, but price now move to this area here and you are already on a losing trade from that point. Never add more positions to a losing trade. So some people will be like, okay, let me enter for more positions, and we enter another position here again. Use another stop loss at that point. So how this can be a big disadvantage is that price can just decide to keep going higher. Price can decide to keep going higher. First of all, hit your first stop loss for the first trade. Come back again, take out the second stop loss. So this is how you can always be. This is how you can be on a big loss each time you add more positions to a losing trade. And also when you add more positions on a winning trade, this is how price can always take you out. If it's this first trade you take, if it's this first trade you take, always stick to that trade. If you want to open three positions, open the three positions from the beginning, not when price has started moving. You start to open new positions. Always open from the beginning. If you open after price has started moving, there's the high probability for price to reverse or a little volatility in the market. The spread can just hit your stop loss, then price will reverse back in your direction. So always stick to just positions you open from the beginning and not the positions after price has started moving. So that's why you can always apply this risk management. This is all I use for my trade. I don't use different lot size for each trade. If I am to trade on a particular trend today, like this one now, like this one, since price is, let's say price is in a downtrend from here, if you see, I use the same lots and the same stop loss, the pips for the stop loss, I use the same thing for each trade. And the lot size, I also use the same lot size for each trade. When I open three positions, I open the three positions from the very beginning, not when price has started moving. I open the three positions from the very beginning of the trade. So always note this: open the positions from the beginning, not when price has started moving. You start to look for areas to enter for other positions, because there's high probability for price to reverse back, then stop you out from the trade. So in case you have any question, you can ask me on the comment section. And also don't forget to subscribe to my channel so you can get notifications when I will be dropping my next videos. So this is all I have for today, and stay tuned for my next upload. Thank you.